Good morning, everyone. Let everyone join in. Give me 1 minute's time so that everyone can settle down. Let me also open the chat box. Let everyone join in. Give me 1 minute's time. Yes, good morning, Rahul. Good morning, Renisa. Good morning, Linda. Good morning, Sopna. Good morning, everyone. I hope you're all doing good. Yes. All right, friends. So, shall we start off with today's session now? Okay. So friends, we were doing the 15-hour marathon and we have covered quite a lot of questions. What is left for doing today is forex and derivatives, a crucial part. So let us do that today and let us pack up with today's session also. 1 minute, where is the... Okay, just a minute. Let me just download the document also. Okay. Yeah, Sridevi, can you hear me? Hold on. Are you able to hear me now, friends? Am I audible? Please type a yes. Sridevi, the importance of these questions is that they are all minimum questions covering maximum adjustments. That's what we have done over here. So, like in yesterday's class, we have covered very less questions, but that would cover at least 70% of your AFM topic. So, examination point of view, we are trying to compress as much as possible so that in less time we can score more marks. That's the ideology behind this entire session, friends. All right. Yes. So only tough questions either from study material or from my ODB materials what we are covering over here. All right. Yes. Fine, friends. Now we are going to the next part, that is FRA and IRF. So shall we start by writing the basic data first? Okay. Right. So I'll just write down. What is the question number 2? Question number 2 of interest rate derivatives. Okay. So I'll write down a heading. Question 2. Interest rate derivatives. All right. So now in this I'll write down point number A. So what is first thing they have told? The amount to be borrowed. So I'll write down over here amount to be borrowed. So everyone tell me how much is the amount to be borrowed over here. Is it turning out to be 50 million euros? That is the amount to be borrowed. Am I right? In about 3 months for 6 months duration. So after 3 months for 6 months duration means 3 into 9 FRA will be relevant over here. Okay, point number C. Then they have told that they have given you the quote. They are borrowing 3 into 9. So down if you see 3 into 9, 5.64 is the deposit rate, 5.94 is the borrowing rate. So I'll write down 3 into 9 FRA borrowing rate will turn out to be how much, friends? It will turn out to be 5.94 percentage. All right. 3 months, 50,000 euro futures contract. So the contract size for futures, or I'll just write down duration of IRF is how many months? 3 months is the duration of IRF. 50,000 euro futures contract. So the contract size of IRF is equal to how much? 50,000. Is quoted at 94.15 tick. So tick value of IRF. Tick value of IRF turns out to be how much? 94.15 ticks. Okay, that's it. Can you please put up this basic data in your books? Alright friends, once you are done with this, now what we have to do is we have to solve this problem in two scenarios. If the actual rate is turning out to be 4.5 or if it is turning out to be 6.5. So what I'll do is I'll just put a working note heading. First we will understand the impact on what? Impact on FRA. Particulars situation 1, situation 2. Okay, so I'll put Roman number 1. First, we will find out the impact on the FRA market. Alright, so now when you are doing in the FRA market, what is the FRA rate that is already mentioned over here? Is the FRA rate 5.94 percentage? That means once you enter into an FRA, by default you have to pay only 5.94 percentage. Alright, now what is the actual rate that is available over here? 4.5%. The other one is 6.5%. Whatever be the actual rate, you will end up borrowing at FRA only. Am I right? So what I'll do is I'll put over here gain in bracket or loss without bracket. That's because overall the question is on an outflow. So now see, outside rate is 4.5. Still I have to borrow at 5.94. I am going to make a loss of how much percentage? 1.44 percentage. Whereas here the actual rate is 6.5, but I have to pay 5.94 only. So I make a gain of how much percentage over here? 0.56 percentage. So when I find out this, I'll write down point number D, gain or loss in rupees, or I think what is the question about? In euros, sorry, gain or loss in euros. So when you do it in euro, the formula would be 500 lakh into 1.44 percentage. You are borrowing for 6 months. Here also 500 lakh into 0.56 percentage into 6 months. Can you work out and tell me what is the amount that you get over here? Do you get the answer as 3,60,000? So here you make a loss of 3,60,000. Here you make a gain of 1,40,000. Okay. Once this part is over, I'll write down point number, or I'll put Roman number 2 now. Roman number 2, spot market. So in the FRA market, one part over. In the spot market, I have to pay interest. Am I right? So the spot market, what will I do? I will borrow 500 lakh at the rate of 4.5 percentage. That is the actual market rate into 6 by 12. That will end up to be how much? 11 lakh 25,000. Same way in the second case, it will be 500 lakh into 6.5 percentage into 6 by 12. 16 lakh 25,000. So when I take up these two numbers, I need to find out what is my net payment. 11 lakh 25,000 plus 3 lakh 60. Here I end up paying 14 lakh 85,000. 16 lakh 25,000 minus 1 lakh 40,000 will be again 14 lakh 85,000. Or in other words, however the interest rate moves, whether it goes up to 4.5 or whether it goes up to 6.5 or it comes down to 4.5, ultimately I will end up paying only 14 lakh 85,000. Hence I can sleep peacefully. This is the power of FRA or any other hedging technique for that purpose. Can you write down this in your books now? Yes, friends, I hope you're all done writing. Okay, you can scribble and write down so that we can quickly move to the next question. All these solutions are already available as I have already told you yesterday. I'll just show you the same answer in my handbook also. Look at this, the same 14 lakh 85 is come here also. So it's, this book is anyways given to you. In this class, we can do it a little faster. Okay. Are you all clear with the concept of FRA right now? So can I go to IRF? Okay. Right. So next, let me take IRF. Okay. So let me move to the next part. Next working note heading will be analysis of IRF. So when we do IRF, point number A is amount borrowed. So everyone tell me how much is the amount borrowed? 500 lakh euros is the amount borrowed. Am I right? What is the duration of IRF? IRF duration is only available for 3 months, whereas my actual borrow duration is for how many months? It is coming for 6 months. Therefore, what will happen is if 6 months is the actual borrow duration and IRF is going to be 3 months, the amount to be hedged in IRF, will turn out to be how much, friends? It will turn out to be 1000 lakh euros. Everybody clear with this part? And we have a contract size also over there. What is the contract size? That will be 50,000 euros. So when you do with this, we can find out what will be the number of contracts to be hedged. So that will be 1000 lakh divided by 50,000. So what is 1000 lakh divided by 50,000? Do you get the answer as 2000 contracts? Am I right? Okay, come on, quickly write this down. All right, friends, can I go to the next part now? Okay, so once we get this, we have to go and solve the IRF part. So I will now again put the table particulars. You have 4.5 percentage and then you have what? 6.5 percentage, correct? So what will be Roman number 1? As I told you, first we'll focus on the IRF market. Okay, so when we do in the IRF market, what do we normally do first? Since it's a borrow, we will sell tick, and subsequently what are we going to do? We are going to buy tick. So when you sell tick, we are going to sell tick at 94.15. Okay, subsequently when you're going to buy tick, the price has become 4.5%. so what is 100 minus 4.5? You will end up buying tick at 95.50, and here you will end up buying ticket 93.50. Okay, so based on this you will make a gain or you will make a loss. So let us see what is the gain or loss that you make over here. Do you make a loss of 1.35? Correct? And here you will make a, I think you are going to make a gain of 0.65, correct? Okay, so as I told you earlier, loss will be in plus and the gain will be put in the minus part. So from this, can I find out what will be the total gain or loss? Okay. So the formula over here would be 1000 lakhs into 1.35% into 3 months, 3 by 12, 1000 lakhs into 0.65% into 3 by 12. All right. So 1000 into 1.35 into 3 divided by 12 will be 3,37,500. Okay. And what about the other one? 1,62,500. All right. What is the next thing that will come after this? I'll put Roman number 2. So you'll have to put the spot market. So what will happen in the spot market? You're going to borrow only how much in the spot market? 500 lakh into 4.5% into 6 by 12. You're borrowing there for 6 months. 11 lakh 25,000. Okay, and the other one would be what? 500 into 6.5% into 6 by 12. Is it 16 lakh 25,000? 11 lakh 25,000 plus 3 lakh 37,500 will be 14 lakh 62,500. 14 lakh 62,500. 14 lakh 62,500. Again, friends, whichever way the interest rate moves, you end up paying exactly the same amount. Hence, you can sleep peacefully. Come on, write down this, friends. Yes, friends, are you all done writing this? Okay, let me just confirm it here again. Here also you will be getting the same answer, 14 lakh 62,500. Everybody clear with this part, friends? Okay, I think yes. So we have done with this question also. Shall we go to the next part of Forex, friends? Okay, even before we go, let me just open this file properly. Earlier in the rush, I was opening it in a haphazard manner. So give me a minute. I'll download this file and open it so that I can easily view it. Yes. And friends, in the meanwhile, please do like this video if this is very useful for you, friends, so that YouTube should also know this is a very useful class that is happening over here. Please do help me with that. Thank you so much. Let me just come down. Next, we are going to do some beautiful Forex questions, which is the last part of this class. One minute. Okay, so we have Forex combined question, in which this is one of the questions I have done in my classes also, but this is one of the best questions. So I couldn't avoid this from my 15-hour marathon. This is a question where they are asking you three particular options. One is forward, other one is future, and the last one is going to be no hedging. So let us just take the question and go through this question. 1 minute. Right. Okay. XYZ is a company which is based in Mumbai and it invoices its customers in the home currency, sorry, in the currency of dollars. In customers' currency, that is dollars. So 1 lakh dollar is receivable after how many months? 3 months. Okay. This is your spot rate. Okay, so now forward rate they have given 1 month forward also, they have given you 3 months forward also. What is relevant over here, friends? 1 month forward or 3 months forward? 3 months forward is relevant. So 1 month forward, not relevant. Alright. Contract size is given for June, for September. What is the month today? I think invoices in a home currency on September 1, that is after 3 months. So today is June. So futures will be for June or for September. Futures will be also for September and this is called as F0. Okay. Now again the margin also June will not be relevant because we are entering for September. So only the September margin will be relevant. Okay. And down when you come they have also given you the spot rate on the other day, that is S1. Okay. Currency future rate on cancellation date, that is F1 is also given. And now they are asking you which is a better one. Should I go for forward? Should I go for futures or should I go for not hedging any particular risk? This is the question. Okay. So I'll now give you 2 minutes time. Read through the whole question, understand the question, after which we will do the solving part together. Alright. All right, friends. So let's start off now. First question is forward contract. Forward contract is very, very easy. They have put up the entire basic data over here, friends. 1 minute. Okay. So first part, they have given you the basic data. 1 lakh dollar, spot rate, 3 months forward rate. You have given the contract size. They have given you F0, margin, S1, all that we have underlined has been given. First part is very, very easy. They want you to find out the amount receivable under the forward contract. So tell me, friends, how do you work out under a forward contract? 1 lakh dollar, forward rate, you get the answer as 47 lakh 1,457. Come on, write down this quickly. Same way, no hedging will be 1 lakh dollar divided by S1. So you get 46 lakhs 88 233. So these two parts are very easy. One is forward and the other one is no hedging. All right, friends. Now the next part is a very challenging part. We have to find out the amount receivable under futures. So when you do under futures, we have to be very careful because we have multiple steps over here. It's a receivable. So what are the steps normally involved over here? Sell future, buy future, sell spot. All right. But even before that, we have to find out the number of contracts, and then you have an opportunity cost involved due to what due to the margin deposit involved over here. So let's do it one by one. Step number one is going to be number of contracts. Number of contracts. So 1 lakh dollar receivable at the future rate. Ideally, I should get 47 lakh 21 435. But my contract size is 4 lakh 72,000 rupees. So when I do it like this, I get 10.003040 contracts. So that is where a small complication begins because I cannot enter into this many number of contracts. Am I right? So what will happen? Practically, I can enter into only 10 contracts. So when I go for 10 contracts, the diagram comes like this. 10 contracts in future, balance I will go either for forward or no hedging. In this question, we go for no hedging. So when you split up the data in that format, you will get these numbers. There's a small correction here. This is 47 lakh 20,000 and here you will get 1435. All right, and 99,969.6 and 30.4. Can you put this in your books now? All right, friends. So once you're done with this and we get the number of contracts, then the steps get easy. Sell future, buy future, sell spot. So when you're selling future, you will sell only 99,969 and you will sell it at F0. Buy future, you will do it at what price? F1. So when you do these two things, you will get a gain of 35,388. Am I right? Then what will you do? You will sell spot. Okay. So once you do the selling spot also, ultimately what will happen? You will get the amount as 46 lakhs 88,232. Then we have an opportunity cost which I'll explain to you in the next step. So first, please write down the steps involved in sell future, buy future and sell spot. Come on friends, write down this now. Yes, friends. So once you do these three things, then you get the amount as these are the amounts that you will get over here. Okay, so maybe you'll get 46 lakhs 88 232. Then what happens? You have put a margin deposit. Correct? We have 10 contracts. Each contract 15,000. Total value will be how much? 1 lakh 50. On that 8% for 3 months will give you another interest of how much? 3,000 rupees. So once you take that, you get the final answer as 47 lakh 20,620. Okay, can you write down this also in your books? This is the amount receivable under futures. Yes, friends, I believe you're clear with this part. So this is how we do this problem under forward contract, no hedging and futures. Everybody clear? Shall I go to the next question now, friends? All right. So we are done with this futures problem. Next question is also a very, very good question. Again from my ODBE material. These are some extremely good questions which you should work out because they cover maximum areas. Now this question covers forward, money market, hedging and currency options. Three things in one particular question. So that's why I have brought this over here now. Now let's put the basic data first. Then I'll write down dollar payable. How much is a dollar payable? 364,897 dollars. All right. The amount is payable in how many months? So what is the duration they have told over here? The duration is turning out to be 6 months. Duration 6 months. And they have given you the spot rate and they have given you the forward rate. All right. So I think we'll put the spot rate 1.5617 hyphen 1.5673. 5673. And what is the 6 months forward rate? 6 months forward rate is 1.5455, 1.5455 and 1.5609. The borrowing rate in UK is 7%. That is 7%. US borrowing is 6%. 6%. UK deposit 5.5. US deposit is how much? 4.5, right? And after that they have given you that the currency options are available under which one option contract is 12,500 pound. Pound is your contract size. Write down this entire basic data and thoroughly understand the question. Option premium 1.7. I think that is exercise price, right? That is $1.7 per pound. Call premium 0.037, and HIJKL. You have then put premium. How much is the put premium? Everyone tell me. 0.096. Right? That's also dollar bar pound only. All these things are dollar bar pound. Come on, friends. Write down the basic data and understand the question thoroughly. Then we'll solve it using forward, money market hedging, and finally we'll do it using currency options. Yes, friends, if you are clear with this part, now let us go and crack it one by one. First part is very, very easy, forward contract. So one thing that we need to understand over here is whether it is going to be a bid rate or whether it is going to be the ask rate. Am I right? We'll draw a diagram. So here it is a payable. So once it is a payable, what will he do? He will buy dollar to make the payment. Bank will sell dollar, buy pound. Okay. Dollar bar pound. What is the commodity? Pound. So what rate will be applicable over here? I'll just write sell pound. It will be the bid rate. So with this bid rate, they will solve it and they get the answer as 236,103. Please do it quickly. All right, friends. So I believe you're all clear with this part now. Okay. So now once we are done with forward, next one is money market hedging. This I'll help you with the help of a diagram. I'm not sure if they have put the diagram here. They put the summary. I'll draw a diagram and explain to you, friends. Here there are two countries. What is the first country? UK. And what is the other country? US. In UK, we have a payable of 364,897. So now what will I do over here? In US, I will create an asset. So how do I create an asset? I will deposit some money which along with the US deposit rates. Can you tell me how much is the US deposit rate? 6% for 1 year, so 3% for 6 months. Okay, this should give me $364,897. So let's do a reverse working and let's check it out. Do I get the answer as $354,268? 354. Wait, I think I've made some mistake. What is the dollar deposit rate? Have I taken it correctly? The UK and US deposit rates is 4.5. How did I take 3? So it will be 2.25% over here, right? Alright. So it's 2.25 percentage. I'll get 356,867. But now friends, to deposit this money over here, I don't have money with me. So first what will I have to do? I will have to first borrow some pound. Okay. This pound I should give to the bank and the bank should give me dollar. So when I give the pound to the bank, I'm selling pound, the bank is buying pound. Pound being the commodity, pound will become the, commodity. So bid will be the relevant rate, bid rate. So what is the bid rate that we have? Spot bid rate. 1.5617. So 1.5617 dollar bar pound is the spot bid rate. Correct? So at this, once I convert, I should get $356,867, and that is what I am supposed to go and invest over here. Everybody clear with this part? So now what will be the value of this X that I should borrow will be 867 228,512. This much I have to borrow in pound at what interest rate? What is the interest rate in pound? Borrowing rate in UK is 7%, that is plus 3.5%. So how much money I will end up paying? 236,510 pound. This will be the money that I will be. This will be paid by whom? A Limited. And this will be used to settle the customer, right? We have a payable, so yes, he is my supplier. I'll have to settle my supplier. Can you write down this and finish it off, friends? Yes, friends, are you all done writing this in your books now? Okay, so we are done with money market hedging also. The next one that we have to do is options. So when we do options, step number one is a very crucial steps where we need to find out the number of contracts. Okay, so first I'll write down what is going to be my dollar payable over here. $364,897. Am I right? So if this is the dollar payable, I have to take the exercise price because that is the price at which we are going to enter into a transaction. So that is 1.7 dollar bar pound. That is the right exercisable price, right? So what is 364,897 divided by 1.7? Do I get the answer as 2,14,645 pound? Am I right? Okay. Once you get this 2,14,645 pound as your pound payable, the next step that we have to work out would be the contract size. So I think it's 12,500 pound. Just confirm. Yes. From this, can I find out the number of contracts? Do I get the answer as 17.1716? So now tell me, can I enter into 17.1716 contracts? No. Out of that, in options, I can enter into only 17 contracts, and the balance I can go for no hedging or forward. Here I will go for forward. Alright. So in other words, this diagram will normally have three layers. Okay, so layer 1 we have drawn, layer 2 will be 214,645 divided by 17.1716 into 17, that is 2,12,500 will come over here, and 364,897, 361,250 is what will come over here, and the balancing figure will go on the other side. That is 2145 will go on the other side. 3647 will also go on the other side. Okay, can you draw this diagram in your books now? Yes, friends, I believe you are all clear with this part. So once we do this, now what are we supposed to do? Now we are supposed to find out how much money is payable. Okay. So first, which market am I going to take? Option market. So in the option market, what is the pound that I have over here? 361,250. 361,250 divided by 1.7. That will be 2,12,500 pound. Let's see how much will go in the forward market now. Forward market will be 3647 dollar divided by, I think we got it over here as a bid rate, correct? Yeah, we found out the rate as the bid rate. So what is the forward bid rate given in the question? 1.5455. 2359 or around 2360 pound. Last part is going to be the option premium. This part is slightly tricky. Shall we do this now? Okay, so now everyone interact with me. Here, first thing we need to understand whether it is going to be a call premium or whether it is going to be a put premium. I'll explain that to you also, friends. Here we drew a diagram, right? See, in this diagram, if you observe, I'll take a blue ink pen. The person is selling pound or he needs a right to sell. So when I get a right to sell, is it a call option or is it a put option, friends? It turns out to be the put option. Am I right? So put option is what? Right to sell. Everybody clear with this part now? Okay. It's a right to sell. Okay. So now let's say it's a put option. So we need to first find out what we need to go and find out the put premium. How much is a put premium told in the question? 0.096. Correct. So here the formula would be $361,250. Okay. No, sorry. 212,500 pound into 0.096 dollar bar pound. I'll get the answer as $20,400. Okay. Now I am not in I'm in UK, so I have to make the payment in pound. So what will I do? I have to convert this. So I'll have to buy dollar and sell pound. So it is going to be the bid rate because the bank is buying pound. So this what will be the spot bid rate. How much is the spot bid rate? 1.5617. Okay. So put premium in pound would be 13,063. Now on this I will have to pay interest for 6 months because rest everything is after 6 months. This is payable now. Am I right? Okay, 1 minute. So what is the UK borrowing rate? 7%. That's 3.5%. Okay, so it will be at 3.5% when you work out. You will get 457. So total premium including interest will be 13,520 pound. Alright, so here you get 2,12,500, 2,360, 13,520. When you add up all these things, you get the answer as 2,28,380 pounds. Everybody clear now? Can you write down this and finish it off? All right, friends, I believe you're all done writing this now. Okay. So this is the amount under option. We have done money market and we have also done forward contract. A beautiful, beautiful question which covers all of these friends. Okay, so let me just come down now. Bid rate. All the answers available here also, friends, but I wanted you to write down because once you write down, it creates an impression in your mind, which is very, very important. Okay. Now, shall we go to the next question? Let's see how many more questions are pending to be done. We have a Japanese yen problem. One, two. This is a very good question. Three, four. That's it. We have just four more questions, friends. Let's do these four questions in one shot and pack up the session now itself. All right. Can I go to the next question now? If this question is done, let's go to question number 3. Okay. Working note number 1, basic data. Basic data. So you have a payable of 5 lakh Japanese yen. So I'll write down yen payable is equal to 5 lakh yen. Alright. Point number B. In order to hedge the risk involved in foreign currency, the firm is considering two alternative methods, either forward or options. This quotation is where the problem is coming. They have given the following quotation JY slash INR. So what does this mean? Does it mean it is yen per rupee or is it rupee per yen? Which is a more powerful currency, friends? This is yen per rupee. They have correctly given JY bar INR, but that's given in capital letters. That's what's creating the confusion. All right. This is yen per rupee. Shall we confirm it? Sorry, friends. Thank you for letting me know. I hope I'm audible to all of you now. Yes. Okay, friends, I was just writing the basic data, so you have not missed out on anything. Just write down this in your books. I don't know why the this thing went off. I think now I am audible to all of you, right? Let me confirm. Yes. Okay, friends, I was just writing the basic. Right, friends, please write down the basic data and understand the question. Okay. All right, friends. I believe all of you are done writing till here in your books. So we have put the basic data. Now we need to find out the answer using two markets. What is the first one? First one is a forward market. Forward market is very, very easy. We just have to decide whether it is going to be a bid rate or whether it is going to be a ask rate. That is the only challenge over here. So let's just find out. So what am I supposed to do? Is it payable? Yeah, yen payable. So what will I do? I will buy yen. What will the bank do? Bank will sell yen. In return, what will I do? Sell rupee and the bank will buy rupee. So here I'll write down yen per rupee is the exchange rate. Am I right? Commodity is rupee. Bank is buying rupee. So what rate is applicable over here? It will be the bid rate. So we have to take the forward bid rate and solve it. Shall we check it together? See, they have given the same diagram over here. It is the bid rate. So using bid rate, you get the answer as 2,53,500. Can you write down this part in your books now? Yes, friends. So I believe you are clear with the first part. Now we will go into what? We will go into options part. Okay, so we need to now go and check. When you're talking about options again, will it be a call option or a put option? He wants to sell rupee. So what does he want? He needs a right to sell. So if it's a right to sell, what option will be applicable over here? It will be the put option. Everybody clear with this part? So let's come down. Okay, just like we told, it is bid rate. Firm is selling commodity, so it will be what option? It will be the put option. Okay, the firm is selling commodity, hence we need the right to sell. Okay, so now let's check. What is the amount payable over here? 5 lakh yen. What is the exercise price? 2.125. So what will be the rupee payable over here? 2,35,000. Okay. On this, premium is going to be 0.098. So this will become the premium. All right. Premium in rupees they'll convert. This will be the premium in rupee. Correct. So total amount payable will be, this will be payable plus this will be payable. So this is the total amount payable. All right, fantastic. Since the outflow of cash is least in case of option, some same should be opted for. That's it, friends. Can you write down this and finish it off? We are done with this question also. Loka Kirti, you can round off. You will never lose marks because of rounding off, but without rounding off, it will be very, very difficult. Only the number of contracts part is where I would recommend not to round off. Okay. George, even two decimals is enough. Okay. Uh, Ultimately, your decision should be correct. That's all. Yes, friends. So I think we are clear with this part. Shall we go to the next question now? Okay. Next question is also a very, very good question. We'll write down the basic data. Okay. American firm has to pay two things. So I'll write down particulars. I'll put Roman number 1, Roman number 2. Okay, then I'll write down point number A, CAD payable. How much is the CAD payable? 10 lakh 10,000. 10 lakh $10,000. And what is the second one? 7 lakh $5,000. That is the second part. Am I right? Due date. What is the due date? 31st July and 30th September. 31st July and 30th September. Alright. Then a firm is risk averse and its policy is to hedge the risk involved in all the foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering two methods, either forward contract or option contracts. It is now June 30. Following quotations are available regarding the rates of US dollar per Canadian dollar from the firm. So what does it mean? It means it is dollar bar CAD. Okay. So the spot rate is given, 1 month forward rate is given, and 3 months forward rate is given. So we'll write down. Okay, that part I cannot write down here, or I'll put it this way. Spot dollar bar CAD. I'll write down in the middle. 0.9284 hyphen 0.9288. Then they have given you 1 month forward. How much is a 1 month forward? 0.9301. After this, you will have what? You will have a 3 months forward. What about 3 months forward? 0.9356. Okay. The price for CAD bar US dollar option on a US stock exchange cents per CAD dollar payable on the purchase of the option contract size $5 lakh. This sentence is so frustrating. They are telling price for CAD bar US dollar option. But we have done the whole question using what? Dollar bar CAD. On a US stock exchange, and then in bracket they have given cents per CAD. They have given this to confuse you. The exchange rate does not change. Cents is nothing but if rupees and paisa, just like that you have dollar and you have cents. The contract size is 5 lakh or 50,000. It is 50,000 CAD. So I'll write down point number D. Contract size is what? 50,000 CAD are as follows. So for that they have given you a lot of rates. Okay. And then they are saying according to the suggestion of the finance manager, if options are used, 1 month option should be bought at 94 cents. So they have already decided that also. I'll write out point number E. 1 month option should be bought at 94 cents. 1 month option should be bought at 94 cents. 3 months option should be bought at 95 cents. So once this question is clear, friends, then solving becomes very, very easy. That is the power of basic data. Okay. For this, it would use forward rate as the best rate. As we already told, forward rate as the best estimate of spot. So we'll give a sentence: forward rate and future spot rate will be the same. Alright. Transaction costs are ignored. Recommend which of the above two methods is appropriate, whether forward or options. Write down the basic data, thoroughly understand the question, after which we will discuss and do this. Okay. Yes, friends, I believe you're all done with this part. So now we'll start with forward contract. Forward contract is very, very easy. There is no much complication involved in the forward contract. There, for July, you will get 0.9301. The rates are directly given. You have to pay 9,39,401. September, you have to pay 6,59,598. Can you quickly write down the forward contract first? Once that's over, we'll go to options, which is a more tricky area. Yes, friends, I believe you're all done with this part. Now, shall we enter into the most important part, option contract? I'll do option contract of July on the board exactly in the same way you will have to do it for September. All right. Option contract for July. So, point number A is what? CAD payable. So, everyone tell me how much is the CAD payable for the month of July? 10 lakh 10,000. CAD. Correct? What is the contract size? Is that turning out to be 50,000 CAD? So now, from this, can you tell me what will be the number of contracts? Do you get the answer as 20.20 contracts? Now tell me, can I enter into 20.20 contracts? No. Only 20 contracts will go in option. Zero point 0.2 contracts we can shift it to what? Forward. Am I right? So in other words, only 10 lakh CAD will come over here. 10,000 CAD will go under what option? It will go under forward market. Now tell me what is the strike price that is told. I think in the basic data we wrote 1 month options will be bought at 94 cents. So I think here let me come down. 1 month we should buy it at 94 cents. They have given a table over here. Strike price 94 cents is what we are supposed to take. Now tell me, will it be a call option or will it be a put option? I have a CAD payable. So what will I do? I will buy CAD. Correct? In this question, it is CAD is the commodity. So if I am buying CAD, I need a right to buy. It will be a call option. Because I need a right to buy CAD. Are you all clear with this part? So now, so I have a call option, correct? So first thing what will happen on this 0.94 cents will be the strike price if I'm not wrong. Right to buy at 0.94. That will be how much? 9 lakh 40,000. And since I have to buy CAD, the bank has to sell CAD, correct? So it will be the ask rate from the banker's point of view. What is the forward ask rate? 1 month forward, there's only one rate, 0.9301 dollar bar CAD. So you get the answer as 9,301. Am I right? So when I add up these two things together, 9 lakh 40 plus 9301, I'll get how much? 9 lakh 49,301 is what I will get total. Along with this, what am I supposed to work out? I'm supposed to work out the premium. So here being a call option, I will take a call premium. So for 94, the call premium is how much? 1.02 cents. That is 0.0102 dollar bar CAD into 10 lakh CAD, correct? You get the answer as 10,200 what? Dollar. You get the answer as 9 lakh 59,501 dollar. Everybody clear with this part? Okay, right. Let's confirm with the solution in your book. They got 20.2 contracts. So 10 lakh balance at spot rate, that is a forward rate, 9 lakh 40, this thing 9 lakh 59,501. Same answer we have got here also. Exactly in the same way you're supposed to do for what? September also. Okay. So can you please write down this in your books first? I'll give you 5 minutes time. This being important, I'm not rushing. I'll go a little slow. Please write down. Yes, friends, are you all done writing this in your books now? Okay, so exactly in the same way, what you are supposed to do, you have to work out the part for September now. That part, can you do it yourself? I'll just show you over here. Out of 7 lakh Canadian dollar, 5,000 will go under spot rate. So, using the exchange rate, it will be 6,65,000 dollar, and using forward, it will be 4,678. Plus, you will be having premium, call premium, total will be 6,81,158. Everybody clear with this part now? So we are done with this question also. Let us go to question number 5, ZAS PLC. I think this is the last question, and this is similar to $1 lakh question that we have done earlier. Okay. So I'll write down over here working note number 1, basic data. Okay. ZAS is in the process of negotiating an order of 2.8 million euro with a large German retailer on 6 months credit. So I'll write down point number A will be what? Euro receivable or payable? Receivable. 28 lakh euro. And what is the duration of credit that you have over here? Duration turns out to be 6 months. Okay. If successful, this will be the first time ZAS has exported goods into a highly competitive market. ZAS is considering the following 3 alternatives for managing the transaction risk. So they have 3 alternatives over here. Okay. First one, Peter has suggested that in order to remove ZAS has to invoice using German firm using sterling using the current euro bar dollar pound average spot rate. So basically, what does it mean? I'll write down. Option 1 is what? Home currency invoicing. Invoice in pound using what? Average spot rate. So you have a bid rate, you have the ask rate. Here you're supposed to take what? Average spot rate is what you're supposed to take. Option 2. Wilson is doubtful, okay, about Mr. Peters' proposal and suggested an alternative of invoicing the German firm in euro but use forward. Sorry, friends. Forward contract. Option 2 is what? Forward contract. Then I will go to option number 3. What is option number 3? Mr. Karen agreed with the proposal, but he wants that should sufficient you sterling. It's a future contract, friends, not further contracts. So third one is what? 6 months future contracts. All right. So these are the alternatives, and then they have given you the spot rate, 6 months forward. Points are given. Okay, that will do it in the second part. Can you write down this in your books first? Right, friends. So I think you're clear with the basic data. Now what we'll do is we have the spot rate, we have a 6 months forward point. So can we find out the forward rate from this? So I'll write down the next to working note, forward rates. So I'll draw particulars. Then you have bid and then you have ask. Okay. So here I'll write down point number A, spot rate. So what is the spot rate? 1.1960, 1.1970. Okay. Point number B is what? Swap points. That is zero point 0.6 and 0.55. Ascending or descending order? Descending order. Add or subtract? Subtract. Alright, so you will get 1.19 and 1.1915. Can you write down this in your books now? Alright friends, I believe you are all done with this part. I think next part is simple now. They have given you the future contract is given. They have given the contract size and everything. Solving part, basic data we have already done. It's bid rate or ask rate. It is going to be the ask rate because we'll be selling pound after selling euro, buying pound. Bank will be buying euro and selling pound. So it is the ask rate. Alright. So this part is also very clear. So first method is which one? Home currency invoicing. So here, hold on. There's a correction over here. I think in the home currency invoicing, we have to take the average rate. Yes, they have taken the average rate over here. Okay, and then using that, they have found out the answer as 23 lakh 40 158. Can you write down this in your books now? Right, friends. Next one is forward contract. Forward contract is also very straightforward. We already got it to be the ask rate. So you have to take the forward ask rate and you are supposed to solve it. Correct? Can you please do the forward rate on your own now? This is the forward ask rate. Please do it. Right, friends. So we are done with forward contracts also. Now comes the challenging part, that is futures. Okay. Right. So in this number of contracts receivable is 28 lakh euros. You have a future rate that is already given in the question. So the pound receivable will be 23 lakh 44 469. But we have a contract size 62 500 pound. So we have to enter into 35.5115130 contracts. Tell me now, friends, practically, is it possible to enter into this many number of contracts? No, you can enter into only 37 contracts and remaining 0.51 will go into the forward or no hedging. That diagram is also given over here. Can you write down this in your books now? Yes, Sahil, you have a doubt. We'll hedge using sufficient future contracts. So the nearest whole number. Yes, that's what we have done now. If you get here 37.51, the nearest whole number can be 37 also. It can be 38 also. Am I right? If you do 38, then it becomes over hedging. That's the reason we didn't go for that. Okay. Right. So friends, once you are done with this part, I'll go to the next one now. So here what happens next? So now it's the receivable, sell future, buy future, sell spot. So you will sell future at what price now? Hold on. Okay, you will be selling future at 1.1943, buy at 1.1873, you will make a loss. And then what will you do? Sell spot. So here it sells spot, there you'll date at 1.1873. Your net inflow will be 23,12,500. Okay, and whatever is the balance unhedged portion, that 38,181 euro will go under forward receivable. Total you will get 23,44,544. Can you write down and finish it off, friends? Yes, friends, so we are done with this question. Now, friends, shall we go to the final question? Fantastic. Just read through this question, friends. It's exactly the same as the earlier one. Okay, nitrogen. The name has changed, receivable has changed, but same 6 months credit period. Three alternatives. Okay, First, you have to do it using the current exchange rate. Instead of average, they have given the current exchange rate. Alternative 2 is forward contract. Alternative 3 is what? Sterling future. Spot rate is given. Forward premium is given. This exact same question is what we did right now, friends. So only difference would be here you will be using the bid rate or the ask rate in the first case, but rest all is exactly the same thing, friends. So can you please do this yourself right away now? All right, friends. So I think with this, we have done with all the questions that I intended to do for all of you friends. Okay. I intended a 15-hour marathon, but I think we have covered around 10 hours right now. We have to do RTP also, but RTP, I don't think just in the afternoon session it will get over. We'll plan a different session for RTP, friends. Let this session get over with this. I hope this session was very much useful to all of you friends, and we have covered all the best questions of all the chapters. This will be very useful for you when you're revising one day before the exam. I already have given you my ODBE book. This is a compressed version of the ODBE book with a difficult number of questions with less, in lesser time. So we can cover the entire problems in a very, very short span of time, friends. So I hope this session was useful for all of you friends. Thank you so much for your patience and your trust in me. We will work together. We will win together. Today night, I have a mentoring program. Please attend that also, where we'll be discussing the study plan and we'll be having a mock. We have done a mock paper, right? We'll do a correction of the mock test paper today night. All right. Thank you so much, friends. All the very best. Do well. I am with you. Any support you want, feel free to message me. I hope you have my number. If you don't have it, please save it down. Thanks a lot, friends. Take care. Have a good day.